When 30-year treasuries yield 3%, that kind of sets the bar for everything else. Everything else trades off of that, which means not at very high returns. And that means we're in a low return environment. And one of the things I believe is that we must understand the environment we're in, understand the ramifications, and accept it in the sense of accept the reality and not think that one of the hardest things is to make high returns in a low return world. And if you insist on doing so, you can get into trouble. If you say, well, treasuries used to be 6 and high yield bonds traded at 500 over, so I made 11 with ease on the average high yield bond. And so even though treasuries are now 3 or 2 on the 10-year, I still want 11. And I'm going to get my 11. If then you end up making investments that may be poised, it may appear poised to pay 11, but because you now need 900 over, you may take greater risks than you used to take to get the same return. So just insisting on making the same return that you used to make can be very dangerous. And Peter Bernstein once wrote me, and brilliantly, he said, or maybe he passed on a quote from Elroy Timpson, who said that the market is not an accommodating machine. It will not give you high returns just because you need them. And you have to realize that. So, if you say, look, I used to get 9, I used to get 11, I still need 11, so I'm going to take more risk, you can do that. But the key is to recognize that you have to take more risk to do it and to make a conscious decision that you're going to do it. But blindly accepting more risk to get the return you used to get in a high return world, it can be a big mistake.